Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Starbucks this morning, stock is up 3.5% pre-market after their Q1 earnings release. And really, if you're buying Starbucks right now, you're not really buying one earnings release. You're buying the idea that Brian Niccol is going to bring them back to greatness after their prior CEO, who kind of sucked, left in September. They announced the hiring of Brian Niccol in August, and the stock jumped $20 overnight and it's kind of stuck in that area since then. So you can kind of see the excitement that that hiring brought to the company. It'll be interesting to see how that plays out in the earnings, but right now it's too early to tell. They have their back to Starbucks strategy. They're seeing early good progress on that. They're reintroducing Starbucks to the world. They have a clear path forward. If you like buzzwords, you're going to love this earnings release. It's right up your alley, buddy. You've got net revenues at 9.4 billion, basically flat towards the prior year. EPS down quite a bit as they are investing a lot into this back to Starbucks strategy, investing in their stores, investing in their employees, investing in changing their food menu, cutting about 30% off the offerings down, investing in coffee, all of that stuff. As you look at North America, not amazing here. You've got a negative 4% change in comparable store sales, driven by a negative 8% change in transactions. So big drop in volume, and that's consistent with the last couple of quarters as well. Ticket up about 4%, not necessarily driven by price, as stuff here is already pretty expensive, but also reducing discounts. Then you've got a 3% increase in store count, leading to net negative 1% net revenues. Operating income down quite a bit because of all those investments that I mentioned. And again, stores 18,500 in North America. And really their long-term goal here is to basically have double that. That's going to drive a lot of growth in the future. If you think about the number of Starbucks in your area, do you think you can have double that? That's really the assumption you're making if you're an investor in Starbucks, which I am not, but keep that in mind if you're thinking about investing. Like, are they going to be able to grow through additional stores if they already have too many in your area? Where are they going to put those? A lot more competition coming out as well. You've got Dutch Bros growing. Luckin Coffee, one of their biggest competitors in China, is actually starting to open up stores in the United States in 2025. That's a lower price alternative. Will that hurt Starbucks in any way? They're starting in cities that have a bigger Asian population, so think New York City, San Francisco, etc. But that'll be an interesting development for these guys. Internationally, transactions down 2%, ticket down 2%. Again, price is a driving force in a lot of these international markets. China is going through a little bit of a minor recession maybe, but also there's a lot of lower priced alternatives like Luckin Coffee there, driving probably necessary cuts from Starbucks in international markets. Stores up 7%. And again, a lot of store count growth here, probably going to continue to be the case for the foreseeable future. Net revenues up by 1%, operating income basically flat, down a little bit. So not a huge margin difference like you see in the United States. They're really just investing mostly in the United States, mostly keeping things as is. Internationally, maybe cutting prices a little bit to compete with lower priced alternatives as people focus on their pocketbooks a bit more. And then you've got their channel development segment, which again is the ready to drink drinks they have in stores. This is a good high margin business, but a low revenue as far as their overall business goes. Still a good impact to the bottom line. Again, United States certainly struggling a bit, but they still have 35 million active Starbucks members, 3.5 billion in card loads. People have their Starbucks cards that they put money on, gift cards that they give. And again, that money just sort of lays there until it's used. And Starbucks kind of acts as a bank intermediary, can invest that money in short-term treasuries, earn a little bit extra. That's one thing they get going for themselves as well. But end of day, this is very much a coffee business. And that coffee business is obviously by the numbers struggling a bit, trying to turn it around, trying to get back to growth, because that growth hasn't been there. If you look at 24 results flat, 25 results expected to be about 3.4%. Then the expectation is with this new CEO, 7% growth the year after, 9 to 10% growth again for the foreseeable future. Is that a bit aggressive? Kind of seems like it to me. We'll see if the valuation makes sense here. As you look at valuation from a PE perspective, it's trading in that like 30x, 31x multiple range. Again, that's sort of high in relation to the historical norms. You've obviously got this bump over here, but even including that bump, the mean is in the high 20s. You've got anywhere from like the high teens into the low to mid 30s on a normal year. So kind of trading on the upper end of that range on the assumption that earnings are going to grow at a faster clip than they have in the past. But when you were trading in these ranges, this was growing in that 10 to 20% range. Now it's basically flat. Seems relatively expensive. As we look at free cash flow yields, which is what I'll price it based off of in my analysis, it's sort of in that like 3 to 4% range, sometimes in the high 2%, as high as 4.5 to 5% at times on the worst day. So you certainly are able to buy it at a lower price than it's trading at today, because it's trading closer to the low threes, depending on whether you're looking at the next 12 month or the prior 12 month. Disclaimer, as we look at the valuation, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Again, I'm assuming about 3% growth in 25, 6% growth in 26, and then kind of slowing down again into that 5 to 4% range. I think the assumption that they're going to grow at 9% in 2 to 3 years, probably a bit optimistic given what we're seeing right now, but certainly if you're more optimistic than that, feel free to play around with this, hit file and make a copy. There will be a link to this in the description down below. They do pay a dividend, about 2.5% yield right now, maybe slightly lower after the increase today. I'm going to grow that at about 6% for the next couple of years, so that's out there. You can change this number if you'd like. They do have a buyback. In the last couple of years, it's been in like 1 to 4 billion range. If they buy more than, like, let's say 1.5 billion, they probably have to take on debt to do so. So keep that in mind. They already do have a decent amount of debt and capital leases. So I don't know if they're going to take on debt to buy back shares anytime soon. They're probably focused more on growth. So I have about 30% of their free cash flow going towards buybacks. The rest is in dividends. Obviously, the buybacks offset by stock-based compensation to get to your net buyback. That's impacting this buyback yield. As far as valuation goes, what's the right number here? Like, you've got a 3% valuation on a next 12-month basis, about 2.9% on a trailing 12-month basis. If you sort of put it in the middle of where it's historically traded, based on the assumption that Brian Niccol will kind of get them back to their historical norms, you're getting a 7.5% return based on the price based on the price before today's open, $100.41. If I want an 8% target return before dividends, down to about 10.5% after, it gets me to a fair value in that like $89 range. So again, an expected return of about 7.5%, inclusive of dividends, inclusive of buybacks, based on today's price. Seems kind of expensive right now. Seems like the assumptions you have to make are more in line with what the market sees. If you think this is going to improve margins by more than 120 basis points, and you think that growth is going to get back to high single digits, maybe even low teens because of Brian Niccol's valuation, probably makes sense. If you're more in line with what I have here, it seems kind of expensive. And even the assumption here at a 3.5% yield might be kind of on the aggressive side, because historically, when this stock has grown in the low single digits, and if it continues to do so, if there's pressure from some of these new entrants in North America, if there's pressure on pricing because the economy slows down a little bit, because people don't want to spend $6 on coffee anymore because of inflation and how that impacts all of the other purchases, maybe the right number here is a 4% free cash flow yield, which is kind of historically where it's traded. And maybe even that is aggressive. You get a fair value close to $77, an expected return at a $100 price point of 4.9%. And that's more in line with where it traded before Brian Niccol. Now it's trading with this assumption that, hey, this is going to get back to where Starbucks used to be. And if that's the case, then yeah, I get it. I sort of get why you're buying at 89. If you're assuming, hey, we're going to get 9% growth over here, like the market's saying, that's where the price point's coming from. That's the assumption you have to make. You have to assume, we're going to get back into high single digit growth. We're going to improve margins back to, 11% or so, raise the dividend, keep buybacks going. Things are going to be great. But I feel like that assumption is risky and aggressive, and I wouldn't want to make that assumption to sort of get what might be a market level return. Because again, if you look at Starbucks' performance in the last 5 years from a stock price perspective, it's not all that impressive. You're talking about, a 2% annual return prior to dividends, maybe 4% after dividends. So that's the downside you're seeing here. If you're buying this, you're sort of going to be well below market if they don't actually deliver on the growth assumptions that the market's forcing you to make. And I feel like those growth assumptions are aggressive when you've got, hey, Luckin Coffee is now coming into North America. How are they going to compete with that? Is that going to impact their ability to raise prices, raise ticket? They're seeing transactions down high single digits. How are they going to turn that around? Yes, back to Starbucks, clear path forward. Sounds very good. But I need to see it in the results. And obviously, you're not seeing it right now. The market's already sort of assuming that that's going to happen. And to me, the upside from that just isn't all that exciting. Whereas the downside is probably something that means that you're going to be trading at $100, 3 to 4 to 5 years from now, which isn't all that exciting. And is this a company that's going to go under? For sure, it's not. I mean, Starbucks is going to be around, but if it wants to have a market beating return, it has to grow again in the 10% range for a couple of years from today. And that's not going to happen this year or next year. So this might be just sort of slow money for some time until you start seeing those results. And maybe there'll just be better opportunities to get in if you do want to own Starbucks. Obviously, if Q2 is amazing and things explode, maybe you missed out on that boat. But to me, the upside just doesn't seem all that attractive, and the downside seems a bit more pronounced versus just investing the money in the market itself or something else entirely. So what do you think? Am I wrong by any means? Am I just underestimating Brian Niccol? Let me know if you think so down below. Leave a comment, like, subscribe, all of that good stuff. I'll be back with more videos. Hope you're having a good week. Hope you have a nice cup of coffee before you start your workday or whatever it is you do. Otherwise, thanks for watching. Enjoy the rest of your week, and bye.